By any reckoning, being an insurer in India is a great deal. There are 55 of them right now, not including the reinsurers. Among them, Reliance Nippon Life Insurance is not the big one. It doesn't figure among the top 10. It's what you would call a middle class. But the dogfight for its control has pulled in Aditya Birla Group, and on the other side there is Nippon Life. And these are obviously page 1 news, justifiably so. Next door, a bank, no less, IDBI Bank, shall be privatized. What do you think will be the interest of the investors to pick up this bank? And the next in the queue are Bank of Maharashtra, Indian Overseas Bank, Bank of India. How will the investments pan out? 75 years into independence, successive governments have run banks to ground with strict control. On the other side of the fence, insurance companies rising from the mud of open competition are now today prize properties. How did this happen? We examine in this issue of On Point. There are juicy numbers to the story, but we shall come to them later. Insurance companies are like the urchins playing in the mud in the big cities. They sell policies which no one is very clear on what they are meant to do. They sell medical insurance, which are often not particularly useful. They sell life insurance with flat endowments. And who can forget ULIPs, the unit linked life insurance policies which had investments written all over them but no insurance. In the process, they have hardly connected with the vast mass of people in India. Their agents have missold policies, and the results you can see very easily. For instance, if you go to a motor accident claims tribunal, you will know how to get a motor accident policy done, the claims done. In one North Indian state, insurance companies sold personal accident on dead men. It was a gory sight. And there are others, for instance, which even make state governments feel that insurance is a scam, which is why they often are not particularly happy with the crop insurance that insurance companies have to sell. Yet, as per this Swiss Re report, India is ranked 10th in the global insurance business. In life insurance business, it is there 10th. In non-life insurance business, India is ranked 14th. Insurance penetration in India has, however, hovered at less than 4%. Of course, IRDAI now claims that the figure has gone up to 4.20, but that's put it down mostly to those government run schemes, the PMJAY, the PMJJBY, and the PMSBY. The total capital of the life insurers as on March 31st, 2021 was just rupees 28,346 crore. During 2021, the private sector insurers brought in how much? Just rupees 258 crore as additional capital. In life insurance, total benefits paid by the private insurers was just rupees 1.13 trillion. That was in FY21. In FY20, it was even less than 1 trillion. So, these companies were not even needing to raise capital. Look at this FDI chart. The headroom is huge. Why? The one thing that these insurers, the private insurers, did not want to do was to become too big too soon. We all, that is the commentators, the government, they all asked them to reach insurance out to the Janta. But these insurance companies instead chose to wait. And it's been a long wait. Of the private insurers, life insurance sector, for instance, of 23 of them, 15 have completed 15 years of existence. In the general insurance space, 8 have completed 15 years of existence. But what did they do during this time? They sat in the motor insurance dealers, they sat in the banks, bank assurance, they sat in the malls. Look at this figure of micro insurers. Motor insurance sales agents are 1/3 of that. Micro insurers covered the entire India. Motor insurance dealers, 1/3 of that. Banks, as you can see from these numbers, had become just corporate agents of these insurance companies. This wonderful strategy worked. The companies took care of themselves. There was an industry-wide tax raid, service tax on Motor Car Dealers and Insurance Companies Association. Now, how did it happen? Essentially, the motor car dealers were padding up their services to the insurance companies and covering it up without showing it as a service charge. There was an enough amount of problems about that. The claim went up to something like 3,000 crores, and former finance minister Arun Jaitley had to intervene, or at least was asked to intervene. It didn't stop there. Recently, there has been a GST, goods and services tax raid on several insurance companies. What's the problem here? Again, the companies were taking extra input credit for their services and were not passing it on to the treasury. Now, these are serious issues, and we'll have something to say about them later. But what it did was that the insurance companies were kept very comfortable, or rather they took care to keep themselves very comfortable. The people could have done with a little bit of insurance cover, a little bit more of insurance cover, but that didn't come. This harsh strategy meant that instead of chasing numbers, the insurance companies were chasing profits. Now, look at the market cap of those listed. That will tell you very little. Take a look instead at something more, which is an insurance industry metric, the embedded value. Now, what does embedded value means? It is basically the adjusted net worth, which is the market value of assets supporting the surplus, plus the present value of the expected future profits of the in-force business. Those numbers are looking very impressive, as you can see. Take a look at another metric. This is the value of new business. Now, this is an assumption. What does it assume? That the number of future years the insurer has to underwrite at the same rate what he is doing now. So, for instance, if you are bringing in 100 rupees worth of new business and the value of new business is presumed to be 20, you will keep on doing that for the next several years. My assumptions are all taken from public sources. But then here, look at something more. Lives covered. What is the distance from Reliance Nippon Life to that of, say, an industry leader like ICICI Prudential? 3 times, not much, and we are talking about here in lakhs. So, why shouldn't Reliance Nippon get a good valuation? Now, this is the basis of the story, that all these insurance companies, after having kept themselves away from chasing numbers to instead concentrate on building profits, are now at a very good stage. Just when the economy is picking up, their gunpowder is dry, they are ready to take off on the growth swing. What happened to the banks meanwhile? I mean, mostly the state-owned banks. That story is well known, but still, to put the comparison in perspective, let's look at the market cap of some of these banks compared to the leading insurance companies. The insurance companies are getting very close to the market cap of these banks. And that's not all. They are doing something more. They are clawing away at the bank's business. Now, that is a sign of worry. Also, look at something else that's happening with the insurance companies. They have built an ecosystem around them. This ecosystem is of insurance brokers, this is of third-party medical assist providers, this is of web aggregators, these are of insurtech companies. What about the banks? Even the RBI deputy governor, as this report shows, is getting worried that the fintechs and the NBFCs are taking away, clawing away the business of the banks. And sector regulator IRDAI has opened the door big for the insurers. It's just in time for them to take advantage of the growth surge happening in the Indian economy. The list is big, as you can see. The list includes allowing insurers to invest in unlisted companies. Not only that, general insurance products and forms could actually be longer. More significant, the government will allow one license for all insurance companies, which means that a health, general or standalone insurance business can be started on one license. The paid up capital requirement, which was 100 crore for insurance companies and 200 crores for reinsurance business, those will now be decided by IRDAI. But let me ask you something which is what makes me very worried. We talked about the GST problem of the insurance companies. We talked about the motor dealer related problems of the insurance companies. We also talked about mis-selling. How many of these have been looked at as issues of corporate governance misdemeanor? And how many of these have actually reached the stock exchanges? Not much. In fact, hardly. And that is something that the regulator has to seriously account for, that the growth phase in which the insurance companies are now picking up, is it being built on the sound footing? Remember, the banks got into problem for hiding bad assets in 2010, and that was something for which the Indian economy has paid heavy price. We know now that the insurance companies are doing great, but it will be something that will be worth looking at, that whether that greatness has something to be worried about. So it seems that the insurance companies have got their cake and they can eat it too. Remember a few months ago when the insurance regulator Debashish Panda had actually said that there should be growth targets. Remember that bit about chasing numbers? Growth targets for insurance companies. These companies had gotten mad and had gotten back to say that's not possible. That's all forgotten now. Expect the consumers now to move to the insurance companies for a much more well-rounded bouquet of financial products. Years ago, banks used to set up insurance companies and give them names: SBI Life, PNB MetLife. Those roles could soon be in for reversal. It's quite possible that an insurance company will buy a bank and give its name, IDBI Bank for instance. And that is all from us this time. See you next time on On Point.